Welcome in, everybody. You're listening to Wrestling Payments, a podcast where we help payment professionals contend with the challenges of modernizing their payments operations and identifying ways to build for the future. If you're interested in payments innovation and modernization, you're in the right place. Now, let's get into it.
Hi, and welcome to Wrestling Payments. That intro always gets me revved up. So today we're going to talk about something that's happening that's an opinion piece, right? So you notice I'm not in my regular attire, my uniform, if you will. And we're going to talk about something that's really interesting, gets me, I think about these things a lot. That's why this is opinion and not any ideas that represent niche or NPG or the banking industry at all. It's my opinions on these things. And what we're talking about today is a recent executive order that came in, and it established what we're going to call the fintech regulation cage match. And what it is a May 19th executive order called Integrating Financial Technology Innovation into the payment into regulatory frameworks. What does that mean? It's a lot of words. A lot of them are a lot of words. But this is full opinion. It's just me, the microphone. I have one light on. So it's really unofficial, if you will. When you look at this topic, you ever see that example of a duck where the duck is floating on the surface? It looks all calm on the surface, but underneath the little legs are moving really rapidly. That's what I think of this. There's a lot of other things going on here that need some attention. And it's not simply the words on the page. The big question that we're going to address here or talk about or prompt is who regulates fintech organizations? And the answer is almost no one. They're not regulated like a bank. They're not regulated like a credit union. They're not regulated like maybe an insurance company as well. There's weird regulations or no regulations around fintechs. That's what we're going to work through today. So let's give an example, right? So I live in Massachusetts. Stoneham is just a hop, skip, and a jump from here. Say, for example, in Stoneham or Canton or Stoughton or Dedham, any of those towns, there's a $300 million financial institution. They're examined head to toe every to 18 months. Examiners come in. They rip everything apart. They look at safety and soundness, BSA, consumer compliance, capital adequacy, liquidity. The examiners come in the door. They pull all the documents and they issue findings. Sometimes they issue consent orders that say, this is broken. You need to fix it. You need to fix it by this time period. Meanwhile, you could have a $500 million payment transaction company, an app company. There is no comparable examination ever. This isn't hyperbole. I'm not exaggerating. This is the truth. And if you look at the order, I don't know if I'll repeat this point again, but if you look at the executive order, it's any fintech. So if I went out today and started Joe's Fintech, I could get a Federal Reserve account. That's what the implications are. We're looking at giving equal access to the Federal Reserve for a Federal Reserve account. And just as a note, at the end, we're gonna finish this episode and we're gonna look like we're done. But if you want to listen a little longer, I have some really interesting after the episode thoughts that I'd like to talk through because I don't know if these questions are raised enough. Fintech is not a bank. They have no traditional deposits. They have no federal charter. No one said, okay, you have enough to be a financial institution. They live in like a free space, an area that there's we'll talk a little bit about governance, but there could be little to no governance. Even the order actually states it, right? So overly burdensome and fragmented regulation. We're going to talk about that. Collaboration between fintechs, federated institutions, and the federal regulators. Translation, the system's broken. It's a patchwork. I agree with that. I think there's lots of bodies doing lots of things, and some of those are the same things, and some of them there's gaps. This order is looking for a prescription, and the question is, can we fill it? So issue number one, I'm going to go through a series of issues, right? And these are right out of the order. I encourage you to read the order. It is written like an order, so sometimes it's a little Greek, but it does reference the CFBP, the SEC, the NCUA, the CFTC, the FDIC, and OCC. They're all regulators. They all have their own areas where they examine certain types of institutions. What do they regulate? They regulate chartered entities, banks, credit unions, securities firms, right? We got into the SEC and the CFTC, securities firms, right? Trading companies. If you're looking at a payment app, right, and let's be fair, a bigger payment app, they do get examined or reviewed by FinCEN. They have to follow AML rules. Okay, maybe not Joe's fintech company that I start next week. The FTC, I'm sure you've seen those findings. FTC finds a company not doing something right, and they issue a fine, they do a finding. They're going to cover like maybe deceptive practices, right? Nobody's doing what the OCC does for its national banks to a fintech. Nobody does the comprehensive check. Issue number 2, right? In the order is written, well, the CFBP will do something. I don't know if you guys remember, but earlier this year, there was an act, the Congressional Review Act resolution. It wiped most of the things that the CFBP was doing off the books. They don't do them. They sent everyone home. They don't have employees. They don't have a budget. They were getting ready to supervise or claim the supervision authority for large non-bank payment apps. That's what they were getting ready to do. $50 million transaction a year was the threshold. So they're big. Think companies like PayPal, Apple Pay, Cash App, Venmo. They were getting ready to say, here's the structure for you guys. Here are the things we're going to examine. Great. And then Congress just said, no, your CFPP's done. They don't get a budget. They don't get people. They're not going to do anything. Yet they're in this order as, well, the CFPP will do this. Then, right? Not to get political. I'm trying not to. I know you hear it, but I'm trying not to. The CFPP itself then proposed limiting its own authority to supervise non-banks. So, I don't know how they're in this as a solution. The one mechanism moving forward towards direct examination, gone. All right. Now, issue number 3, state licensing. If you realize how a fintech's registered or regulated or what rules do they follow, there are rules called money service business rules. And some of them are modern, new, cutting edge. They all agree we're going to all follow the same rules. And some of them are not, including a state that we're going to talk about that doesn't have any, right? So it's not an even playing field. There's not a floor that we can rely on that everyone will do a minimum of this. I know in my own state, and for reasons of shame, I won't mention them, even though you can guess it, they just updated their money service business laws to the point where prior to that, it was as if the laws around the telegraph, sending wires over the wire system, literally the wires, was the payment system identified as this is what the rules are for. So fact, 28 states have adopted the Money Transmission Modernization Act. That's what Massachusetts just adopted after multiple years of trying. 22 states have not. Consumers in those 22 states have the oldest rules, the least protection, and sometimes rules that do not even contemplate any of the payment systems available today. I am going to include this in this handout, the notes, the show notes, some images, but I'll try to. I'll show you them now. Nope, I will show them to you now. Show them to you now. There we go. Share. There you go. So there's one of the images. It's AI produced, presented with a prompt about how do we compare all of these players in the same way. And you can see that all the financial institutions are regulated. They do have some oversight, but there's a gap in where it's a patchwork of different rules, different levels, effectiveness. Maybe I'm not sure how to put that. As we think of all the different regionals, and we'll talk about this. But when you think of the states, I'm sure you heard of New York and their BIT license. They also have the highest level of examination for money service businesses. You have to be licensed. You get examined. They're pretty strong. Now on the far end, Wyoming and Montana, there's no meaningful money service business, including one of them that says, "Oh, if you have a federal one, you're good. We don't actually have one." So it is a spectrum where all of those are discovered. But as we continue on, yep, that's still me. Great. As we continue on, issue number 4 is those states, Wyoming and the exemption problems. So Wyoming, right? and maybe you didn't know this, Wyoming is the most crypto and fintech-friendly state in the country. They were the first to define a utility token as a separate asset class. They created a bank charter, a special purpose depository institution charter, where crypto companies could more easily, I imagine, don't quote me on that, get a bank license so that they can do financial transactions. They are exempted from certain crypto transactions. They exempted some of the crypto transactions from the money transmitting law entirely. So they're very friendly to it. Montana is the one I mentioned. It's the only state with zero money transmitter licensing requirements. They rely on the FinCEN money service business registration. So whenever you hear a fintech get up and say, oh, we are licensed in 9 states, you know what state they're not licensed in because it doesn't have one. The tension to be pro-innovation with real activity or exempting an activity is not the same as making it safe. So what is the right answer? You got 49 different, 50 different versions of oversight. Wyoming consumers have no state license behind their transactions. So if we flip into the idea of, well, how is a depositor or a user or a consumer protected? I would argue in some states they're not really well protected at all. In New York, they're very protected with the bit license application. Same app, right? So if both there were 2 different consumers, one in Montana and one in New York, something can happen, and the one in New York would be protected, and the one in Montana would not. Same app. Different protections, there's no floor, right? So that's the challenge. So again, we're just reviewing. New York has the most stringent, most consumer protection, and Montana and Wyoming are the most permissive and light touch. The protection depends on where you live. That is not a framework. That is a regulatory lottery. How you turn out is where you live, right? And that doesn't seem appropriate to me. The last section is the last issue is to point out in section 4 of the order, that's where the most consequential provisions are and the least discussed. They're asking, and the timeframes on this are pretty fast, right? The timeframes is I need a report on your observations within 60 days, within 120 days. It's not a lot of days. They're going to ask the Fed to evaluate direct access to the payment rails for non-banks. And a non-bank, a fintech, Joe's fintech, could have an account at the Fed where I'm processing payments, sending out payments, receiving payments in a Fed account. They may consider master accounts with no bank in the mix. No financial institution, no regulated organization in the middle of that. That's what spurred me to have this episode. And just as a note, I learned a lot from YouTube, which you may be watching this on right now. I went out to YouTube to say, hey, tell me about this executive order. All I got was crypto firms, and all I got was the president just legalized fintech accounts at the Fed. That seemed to skip a few steps, but needless to say, they're all excited about this. No harm, no foul of fintech firms, just trying to be fair and protective. Okay, right now, non-bank payment companies need a bank partner to access the Fed. In any payment system you look at, there is a financial institution in the mix, most likely on both ends, right? So on the send side, a financial institution is the final step, connection to the operator, the Fed. And on the receive side, it goes through a bank, a credit union, a financial institution on the receive side. So they're the gatekeepers, right? They've done all the regulation, they've done all the examinations, and they know that they're responsible if something goes wrong. They're responsible to make sure their fintechs are following all the requirements that the bank follows. But the bank's not a regulator, right? It's a company. They need each other, right? Fintech right now can't go straight to the Fed. So they need to have a relationship, they need to have agreements and contracts and policies, procedures, views, all of that. If the Fed opens itself to fintech accounts, the dependency is gone. All the rules and the enforcement and the review that a financial institution would do, again, not an examiner, gone. Large fintechs route around the banks entirely. They wouldn't need to use a bank to get to the system. Right now, for example, FedNow, if biggest fintech company in the world want to send a payment through FedNow, they need a financial institution. That's how it works. It is a seismic shift. This is a big deal. It's not, think of the little legs under the water with the ducks, swimming. lot going on. So I try to be fair. I used AI, and this is not all Joe's opinion. Try to be fair. So I think we ended up with 3 or 4 scenarios of what could happen. So scenario 1, complete failure. Executive orders are not laws. They're not regulations. It's not the Federal Reserve Act. It's an executive order. It's a document from the president saying, this is what I want to happen. It directs agencies to do reviews, write letters, make suggestions, set timelines. The Fed simultaneously, the next day, the Fed sent out an RFI saying, hey, we already got your opinion on these, what we call skinny accounts, fintech accounts. We had some questions after all the responses you gave us. Can you answer these questions as well? Nothing's Fed is still pursuing this. What happens sometimes with these executive orders? I said it was 60 days, 120 days. Sometimes those deadlines get skipped. Sometimes the report gets filed, but nothing happens with it after that, and nothing changes. Result, large fintechs get OCC charters anyway, leaving the partnership model. Small fintechs keep navigating 50 states of patchwork, and the CFBP non-bank supervision stays dead. And just for the note, recently, the OCC has been issuing special charters to fintechs. There are several that already has received them. So they are complying with the OCC's version of regulation. The fragmentation gets worse, right? Because now you have banks and non-banks having bank charters, and maybe these non-bank, bank chartered financial institutions get Fed accounts. Maybe they don't. And the consumer in rural Montana, there's still no state license. There's still no federal examination, and there's still no regulatory backstop. That's scenario 1, nothing. Scenario 2, partial implementation, right? This is the most likely to occur, according to my AI. 90-day agency's review happens. Its outdated guidance gets rescinded, right? So if there's some laws, and this happens a lot in the past year, the OCC had previously issued, you should not be touching crypto, do not ban crypto, don't do it. They rescinded those. So all those don't ban crypto went away. And now you can ban crypto. OCC will streamline its charter procedures. There were 14 applicants in 2025. Coinbase, Affirm, Revolut are all pursuing these OCC charters. Large fintechs get chartered, regulated, and examined. Problem solved for them, right? So they said, we'll drink the Kool-Aid. We're in. We will be regulated. And they follow the rules. Consumers get protected. Processes happen. Small fintechs. What happens to Joe's fintech? I started it last week or next week, whenever I started it. They're still going to be navigating 50 states worth of licensing, all different ways that you have to be registered in all the states. Report, the executive order report, section 4, all the reports get done and they sit in bureaucratic purgatory. Consumers, mixed results, right? So maybe they're getting large chartered fintechs with more protection. States with outdated money service laws they're still exposed to that. And it's still a geography lottery. Scenario 3, right? Good story, the good path. OCC fast tracks charter pathway. Mid-sized companies, not just the giants, also can now get the OCC charter. The Fed establishes direct access framework for qualifying non-banks. They implement these accounts. The Genius Act stablecoin framework, coherent federal license tier forming. Right? So if you know the Genius Act, it said, hey, states, you need to form all these rules for managing stablecoins. And if you don't, the Federal Reserve will probably do that. So there now becomes a federal stablecoin regulation. Again, lots of requirements. There is a structure for that. Consumers get a federal floor. New York or Montana, same baseline. There's the same floor. You can't fall below the floor. You'll still get some measure of protection. Bank partnerships model evolves, right? Because now there is no longer that need, that demand to have a financial institution in the mix. It's going to affect the strategic infrastructure. There's going to be changes to that. Now, scenario 4, right? This is even better. This is full success. Tiered federal licensing framework for payment fintech. Small innovators get a sandbox with federal standards, right? I'm small, so I'm going to get access to try out. How could this work with consumers? Let's stress test my solution. Mid-tier will get a streamlined federal payment charter, and systemically important now, we eliminated that word, but we're going to bring them back. They will be approaching regulatory exams, all the same things financial institutions look at. Right vision, hardest path, it does require, just like the Federal Reserve Act, it does require Congress to get involved. It's not going to be done with an executive order. So what does this mean for banks? For banks, more fintechs are coming to your door for partnerships. Reputational risk cudgel is off the table, right? If you've heard all the pushback on what's considered reputational risk can no longer be used as the only reason not to give a company a license and access to accounts. So that's off the table. Examination exposure for partners failure may not change. So again, the financial institutions are going to be responsible for reviewing their fintechs. Are you following the rules? Do you have a BSA program? You have to have a BSA program that matches our BSA program. So even though there's no regulator, the activity will be monitored, and the financial institutions most likely will upgrade, follow through, make sure that the fintechs are doing what they're supposed to be doing. You are still in the regulated entity when things go wrong. Right? So the financial institution is still regulated. When something goes wrong, there's still a regulation. There's still FDIC insurance. There's still NCUA protections. Due diligence is going to be leveled on how much due diligence is needed, right? So for the big guys, lots. For fintechs, maybe little fintechs like me, maybe more, but low, not as much as the big guys. For financial institutions and community banks, watch this report, Section 4 analysis. So it's going to come out 60 to 120 days from now. It's probably going to be pretty quiet, but it has a deadline and it may come close to the deadline. If direct non-bank access to the rails becomes a reality, fintechs will not need you the way they need you today. Question becomes, what value do you bring? You are no longer the keys to the kingdom. And when you no longer are the only gateway to the rails, what happens then? For fintechs, right? So fintechs, the environment is genuinely more welcoming than it was a decade ago. But the charter wave is telling you something. Largest players are choosing into the regulated tent. They're saying, I want a bank charter. I want this special charter you created. So, is that some writing on the wall? They want to be examined. They want the charter. They want the master account. Betting on the gap staying open is a losing bet, according to my AI. I don't want to give anyone advice. Again, these are my opinions and my AI. Now, for consumers, this affects your money, right? I don't know if we've had it happen in a while, but what happens when the fintech disappears overnight? You had money in the fintech. Where's your money, right? This could be a payment app. It could be a digital wallet. It could be your buy now, pay later account. Whether those products are examined or not is abstract. The difference between the floor of protection and none, right? So in the new model, you'd have some protection, but none in the current model, perhaps. Right now in the country, the floor doesn't exist. So it is, I guess it is a good thing to, why don't we start talking about this? That's the cage match. The executive order rang the bell. Bing, bing, bing. Whether anyone wins or loses, it depends on the execution. It depends on the politics. It depends on any congressional action. It depends on the Federal Reserve. What do they do? Will they be bold? Will they be not? I will be keeping track at it. I'm sure I'll have another episode. Until a fintech collapses, funds are inaccessible. Everyone asks how nobody was watching. How could this happen? How did we not know it was going to happen? What are we doing about it? What are we protecting? How are we protecting them? Those are the big questions that I always think about. We're going to watch. That's it for this episode of Wrestling Payments. I'm Joe Casali, and if you stick around, there'll be an episode after the episode. Right before I send you off, I'm going to share another image just to think about. This is how I think about the landscape. The AI did its own thing with that first image. I made it do my design in this second one. So here's what that looks like. And again, I'm going to put this in the notes, but on the one end, the traditional banks, they got all the regulations and the examinations, the stuff holding it up. As we move along, large fintechs, small fintechs, unregulated gaps. I'm with my new company next week is in this last little end, especially if I open up in Montana. So, I showed this, if you know Sean Carter, I showed this to Sean Carter. He raised a very good point, right? He said, why aren't there any potholes over in this first section? Because that's, failures happen sometimes in regular financial institutions, even if they have all of this examination. So it's not a perfect. So I thought that was very good feedback. We're going to update. You might actually see the updated image when you if you download it. But that's it. Thank you very much. You should hear the ending outro right now, and I'll be on the other side of the outro.
On behalf of Nietzsche, your trusted resource in payments, and our guests, I'd like to thank everyone for tuning into the podcast. If you've enjoyed this episode and want to hear more about payments innovation and modernization, you can find the Wrestling Payments Podcast on the podcast page of Nietzsche.org or wherever you subscribe to podcasts. Just search for Wrestling Payments in your podcast app. Thanks for listening.
So here's the thing, and this is what I think about as well, right? I like to think I'm strategic, so I can understand all the concepts in that first topic, right? This executive order says do this, but I also dig deep, 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 right? So as I'm digging deep, 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 let's think of an actual payment example. Right? Thank you. Actually, thank you for being here. It's not the politics of the executive order for this. It's not the Washington process we're going to talk about. It's a rule question, right? And I can talk about safely 4 different payment systems because I know them, and all being discussed as direct access targets for non-bank fintechs. These new skinny accounts. These fintechs are chopping the bit because they want to get their own account so they can do transactions out of their own accounts. If you are a payment nerd like me, let's start with Fedwire. So Fedwire has regulations, has laws. It has state laws as well, right? UCC 4A is a state law that covers credits. There are participants outlined in the models, and the participants include sending banks, beneficiary banks. Fintech's not a bank. Are they the sender? Can they be the sender and the sending bank? Who's going to cover the liabilities? UCC 4A assigns liability all along the way. I don't remember ever it saying the fintech takes liability. So what do you do there? What? How? If the skinny accounts go into effect in 150 days, right? Because the administration says, just do it. Today is Friday. They just swore in the next Fed chair. So what if he says, we're doing it? Do it now. Go. What laws are they going to be following, right? FedNow, right? FedNow, new payment system, right? One of the newest. FedNow has operating procedures. It has operating circular 8, has some Reg J features in there. It also has sending banks, sending participant. It's not a fintech. It's not a fintech. It's a bank, sending participant, sending financial institution. There are, I don't even know if the third party's in the rules. FedNow participation rules written for depository institutions only. And if I recall, one of the ideas was not only would they skinny accounts get a skinny account, they get FedNow access. Okay, but they can't do anything because they're not a financial institution. At least the rules would have to be rewritten. And, I think that's one of those domino things where someone says, oh, let's rewrite the rules. Okay, we're going to have them do this. Oh, but there's a they have to stand behind that, and they should be examined. Are they examined? There's a lot there, right? The executive order, none of this is in there, right? None of it. None of this. RTP, right? Let's talk about RTP as well. RTP, same story. Financial institution, sending participant, receiving participant. In fact, they've gone recently, if you've attended our training, they've have new frameworks in place to actually provide transparency when a third party is involved. So I can give you the example of a MoneyGram, right? A MoneyGram gets involved, and they are now an on behalf of payment. Why are they an on behalf of payment? Because when they're sending a payment through RTP, in this example, it's not their payment. It's my payment. It's a Joe Schmo's payment. It's some consumer using them to send money. So all that has to be identified. That's the OBO model. There's a new IDS model coming out. Again, transparency. That one is a bank-to-bank transaction. That's where, if I understand it correctly, a non-participating bank can send through a participating bank an RTP transaction. Guess who has to be identified? Every financial institution. There's no fintech in that mix. There's none. So they would have to update their rules. They would have to implement their rules. They can't implement their rules overnight. So still a lot there. They do have settlement accounts. So there's the overlay. FedNow has a settlement account. RTP has a pooled settlement account. So I don't know if that's what they're thinking, that it's magic when those payments go through. ACH. So we did have unofficial responses from NACHA. Definitely not going to quote anyone, but they're not really interested in enforcing, hey, if you're getting a Fed account, you need to use ACH. They're like, okay, it's not our business. You want to get a Fed account? Get a Fed account. We don't have a horse in that race. But what if some entrepreneurial treasury person, executive department person says, well, they should get ACH. ACH is great. Everyone uses ACH. It's the best. We use it for treasury. Can you please outline in the NACHA operating rules where a fintech carries a warranty? Because it ain't in there. It's not in there. We have originators. We have ODFIs. We have the operator. Then we have RDFIs. And then we have the receiver. Fintech could be a receiver. Fintech could be an originator. Fintech could even be a third-party sender, which I didn't say. But the warranties are the originating depository financial institution warranty, not the fintech with a Fed account warranty. So what's that? How does that happen? How do they participate? It's interesting. I don't know if I have it here. I have all my notes here. A payment is a payment because there's a warranty behind it. Because there's a law, there's a rule, there's a requirement that says when I send a payment, I promise to pay it. I know it's right. I know it's authorized. If you have a problem, I will be responsible for that entry. If you don't have the warranties, it's just some information on a screen, right? It's not a payment, because if you're sending me $1 million payment and you expect me to give my customer $1 million that you promised to give me, but you could fail because you're not regulated and I don't know what you're doing, and you don't ever agreed to abide by a warranty because it doesn't exist, why would I give them the money? Seems, not a lawyer, not the top brass anywhere, but seems to me that there is nothing supporting that payment in the rules, in a law. The other thing that came out recently was the PACE Act. That was the idea of a skinny account. It was non-bank. Direct Fed ACH access. That's the one that had Fed ACH access. So you get a skinny account with Fed ACH access. Well, that's lovely. Well, Fed ACH. No, it's FedNow. I don't think it's Fed ACH. I hope it's not Fed ACH because they're not a participant. They're not. I mean, some legislator could say, well, yeah, they'll just send it. Okay, but they're not in the rule book. There's no fintech in the rule book. There's an originating depository. Financial depository institution. So I don't know how that happens. NACHA operating rules have no participant category for this type of entity. Sorry, my notes. The D in ODFI is not a technicality. It's a real thing. Option 1, fintechs still originate under ODFI routing number. Now, right, you do need a routing number to use the ACH. We can use the ACH as an example here. You have an originating depository institution. The ODFI is going to be the responsible for all those entries. It has no idea what they are because they're exchanging at the Fed. Didn't go through the ODFI. There wasn't any transparency for the ODFI. Seems more risky, not less. There's no exposure limit for the fintech. So option 2, let's say the fintech gets its own routing number, right? NACHA rewrites Article 1. Again, go back to the warranty. Who holds the warranty? There's no warranties, right? The ODFI warranties are the ODFI warranties, that hence the name. Option 3, nobody figures this out before access goes live. Returns pile up. RDFI asks, who do I pursue for this debit return? Because I can't, they're rejecting all my debit returns. In fact, rules enforcement in the ACH is rules enforcement on an ODFI and rules enforcement on an RDFI. So if someone let the, fintech into the camp, gave them a routing number, allowed them to send entries, and they violate the rules have no teeth for this fintech because they're not the ODFI. They're not the RDFI. Those are the only two parties that the NACHA can go after. So challenge. Again, I covered, misaligned my speaking points. It's all about the warranties, right? So who is going to, not knowing what these fintechs are going to do, who allows the fintech to send entries, who looks at the terminated originator database and updates it if if an originator goes bad. Is the fintech? The fintech, it's not in the rule book right now. The good example here, and is a good example, I think, this is a big risk nightmare, right? So there was a recent story about Synapse Financial. What happened there? Synapse was a third party, a fintech. They partnered with a financial institution to provide some sort of wallet. I only know the surface story. They provided some sort of wallet to customers. And if you understand how this sort of relationship works, Synapse would have the bank account, the account at a financial institution. And on the other side, they would provide wallets to all their customers and say, you have this amount and this amount and this amount, and all those amounts add up to the deposits in the bank account. Synapse, I don't want to get sued. Synapse couldn't do that. They could not reconcile the amounts in the wallets against the amount in the bank account. Consumers got hurt, funds were inaccessible, bankruptcy court got involved, fintech offering services. A direct access model failure could be worse. In the banking as a service, there was a chartered bank somewhere that did their due diligence, probably maybe didn't do it well or believed it when Synapse said, oh, we got this. When there's direct access, there's no other party. There's no one's looking at them. 5 questions for the rules table for the after episode. Question 1 does not need to consider a new participant category. Question 2, who performs ODFI equivalent due diligence on these fintechs? Question 3, return and dispute resolution framework. How do returns work? Are they going to work? I think I would throw the warranties in there, right? Who bears the risk of settling those transactions? Question 4, what happens when a direct access non-bank fails? Not that we're going to think negatively, but institutions fail. And question 5, same question for a FedNow and RTP. Who's going to change the rules? What's going to happen? Do they need to? Do they need to? Consider that. Accessing new systems without rule infrastructure is not innovation. It's exposure. Payment systems are not just the plumbing. They're the trust. Ooh, I like that. They're the trust architects. Every rule, every warranty, every participant has an obligation. Now, the policy question is not whether non-bank firms belong in payments. They already are. The question is under what conditions do they? What are the safeguards? What are the checks and balances and soundness and BSA and all of that stuff? The executive order, the PACE Act, the Fed payments account proposal, they sent out their own. It's just the opening bell. The rule work is the whole fight. How will the industry rise to consider or not consider this? Right now, we have not started training for it. Again, thank you for joining my post-episode. I'm Joe Casali. I will see you next time. There's going to be just silence when I leave. Thanks. If you want to be on the podcast and argue with me about any of these, I welcome you, and I'm a great learner. So if you have a different viewpoint, let me know.
On behalf of Niche, your trusted resource in payments, and our guests, I'd like to thank everyone for tuning into the podcast. If you've enjoyed this episode and want to hear more about payments innovation and modernization, you can find the Wrestling Payments Podcast on the podcast page of niche.org or wherever you subscribe to podcasts. Just search for Wrestling Payments in your podcast app. Thanks for listening.